What really happens when a bank fails in 2025? Is it still the taxpayer who ends up footing the bill? Or has the system finally learned from the 2008 debacle? That's what I want to unpack today, because there's a quiet but important shift happening in how America's banking system safety net actually works. Hey all, welcome to ShareTreck, where science meets investments, and I'm your host Raj. The reason I chose this topic today is that there are several reports that suggesting banks are keeping their balance sheet clean on paper, but are instead channeling funds to shadow banks, lenders that in turn extend credit to subprime borrowers for higher rates. If that is true, then this discussion couldn't be more timely. Because even though the financial headlines look calm, the underlying architectures of how bank failures are managed and who ultimately pays for them is quietly changing. Let's rewind for a second. More than 15 years ago, the 2008 financial crisis happened. The US banking system still carries deep scars from that period. The collapse of Lehman Brothers and the taxpayer-funded bailouts that followed triggered sweeping reforms meant to make sure that never happens again. Chief among them were two things. First, the FDIC Deposit Insurance Fund, or DIF, a pool of money that banks pay into in order to protect depositors. And the second, tougher resolution planning rules under the Dodd-Frank Act, which required big banks to have living wills detailing exactly how they could fail without taking the entire system down with them. For years, that framework worked fine. It built confidence and ensured that bank failures would be contained and not become contagious. Here's the part most people forget. The FDIC safety net is not taxpayer money. Every US bank pays an ongoing assessment into the Deposit Insurance Fund, which then reimburses insured deposits up to $250,000 per account if a bank collapses. After 2008, this fund was strengthened and required to maintain a reserve ratio of at least 1.35% of insured deposits, essentially a cushion for bad times. That's what kept things stable during the 2023 regional banking turmoil when Silicon Valley Bank, Signature Bank, and First Republic went under. The FDIC fund absorbed the insured deposit losses without new taxpayer bailout. It was one of those moments where quiet reforms did their job. But here's where things start to shift. Under the Trump administration's 2025 financial reforms, there has been a clear tilt towards deregulation, putting more faith in market discipline and less in regulatory oversight. Some of the key rollbacks include fewer stress test requirements for mid-sized banks, simplified living will filings, and a new FDIC resolution strategy focused on quick weekend sales of failing bank instead of longer, more structured bridge bank process. According to FDIC's own 2025 resolution readiness update, the goal is to sell failing banks over a weekend before confidence collapses and balance sheets melt like ice cube. The idea is to contain damage quickly, but it also assumes private buyers will be ready and willing when the trouble strikes. And that's a big assumption. And in project management, they say every assumption is a risk. And that's a big assumption in a digital era where panic spreads faster than regulators can hold a press conference. Now let's talk about something that flew under the radar. During the 2023 failures, the FDIC's receiverships had to borrow over $270 billion from the Federal Reserve to cover immediate payouts. And those loans came at a penalty rate that cost the FDIC $1 billion. That was a wake-up call. Since then, FDIC has been testing new ways to raise cash fast, including securitizing assets through Federal Financial Bank. This move reduces reliance on Fed's emergency credit lines and makes the system look more self-reliant. But in practice, it shifts the risk into the market itself, and that's not always a stable place to store confidence. And that's where we as retail investors have to be careful when there are rumblings that the financial system may not be as strong as we think it is. For ordinary depositors, not much changes. Your deposit up to $250,000 are still fully protected. But for investors and markets, these structural shifts mean the next crisis could move much faster. In an era of real-time banking apps and instant withdrawals, the FDIC's ability to act over a weekend could make or break the system's stability. It's a reminder that even with all the post-2008 protection, we are never more than a few bad decisions or a sudden panic away from another liquidity crunch. So, are we safer than before or just more confident? Well, the truth is, the post-crisis safety net hasn't been dismantled, but it's been reinterpreted. What was once a strict barrier between taxpayer risk and mismanagement is now becoming more flexible, more market-driven, and more political. With banks quietly extending credit through shadow lenders, we may once again be pushing risk to the edges of the system, out of sight, but not out of danger. Well, friends, if you want to know more about this shadow banking system and more details about today's video, check out my Substack. Subscription is absolutely free. We have an article in there which gives more details. And I'll also be making one more video on shadow banking dangers, what exactly is shadow banks and how we are exposed to danger out there. Watch out for that later this week. Thanks for watching this video, and if you found this breakdown useful, please consider subscribing and help grow the channel, and please consider subscribing for free to the Substack. Link to the Substack is in the description. Well, friends, that brings me to an end of this video. Bye for now.